another podcast with Investing Education Academy. We're doing things a little different today, meaning we're doing a recap of the first half of 2022. What's been happening in the market? What's notable? What did we predict? What didn't we predict? Yeah, it's going to be a lot of that. If you have questions, please, if you're watching the live, please type your questions in. We will do our best to answer them. If you are listening to the podcast while you're driving, running, whatever it may be, you can go to ieapodcast.com and post your comment in the next to this particular podcast, and we will get back to you if as we can. So, with that being said, we see people already popping on. Tell us who you are. Tell us if you have any questions about the market. That's what we're here for. And Leon, it's on you while I do a little bit of housekeeping.
Yeah, so we're going to recap a little bit of this tumultuous year. So first thing, news came out. Okay, so we're now into July. So the first 6 months of the year are done. They're in the books. And as we all know, they have been essentially horrific. And we now know how horrific they've been. So the first 6 months of 2022 was the worst start to the market in 50 years. 50 years. So many of us that are watching this weren't even alive the last time the market was this bad. The first 6 months of the year. This is a historically bad market. And then what's crazy? The worst part is we're coming off 2 years of, I'm gonna say historically good, but I think we had 2 back-to-back years over 20%. So I mean, we were all just we thought we were all geniuses. And then this year smacked us all in the face and let us know, okay, that wasn't necessarily reality. Which, by the way, Brent and I said early 2020 that this is not going to be the typical market. We didn't know it was going to go up the way it did, but we're like, yo, just what we're going through right now with this pandemic, and it's not normal. And those 2 years were not normal. What we're going through right now is basically a reset of the market and of what they call Fed policy or monetary policy. It's where so just real quick, back in 2008, 2009, most of us remember the credit crisis, the housing crisis. The economy almost imploded literally because the housing collapse. Back then, the Federal Reserve took rates from around 6% around that time, dropped them all the way down to zero, effectively zero. Over the next, so that was in, let's say 2010. So they were effectively 0, 1.5 ish for about well, let's say they're anywhere from 0. Let's even just say 2%. So for about 10 years, from 2009, actually 11 years, from 2009 to 2020, we had rates that were low, right? I mean, interest rates were under.
It was almost like free money.
Yeah, yes, it was almost like free. I mean, rates were under 2%. We all know from our savings accounts, we were getting nothing at our savings accounts. If you went out and got a loan, car loans, house loans, they were relatively cheap, historically speaking. But then what happened in 2020, of course, the pandemic hit. The Federal Reserve, because remember, rates were anywhere from 0 to 2%. By about 2020, we were more near the high end, between like 1.5, 2%. The Federal Reserve then dropped rates again back down to 0. And on top of that, so we had free money, and then the government gave us in the form of stimulus and other programs, somewhere between 2 and 4 trillion with a T, $2 or $4 trillion that was pumped to the economy, free money, as well as any loan you want to get was essentially free too, because the interest rates on those loans were 0. So the money, we were just awash in money. I mean, the economy was awash in essentially free money, and we bought everything: cars, homes, cryptocurrency, stock market, gold, you name it. Everything went up for the past 2 years. Well, party is over. Federal Reserve, as we all know, is now raising rates pretty aggressively too, because inflation, as we've talked about before, is at a 40-year high. So we had the worst stock market in 50 years. The reason that is because inflation is at a 40-year high. So we're at truly historic times right now, and the market is getting absolutely battered. And we've all felt it this first 6 months. So
real quick, before we dive into the first 6 months, the first 6 months have hurt like I don't know what. And that's true. But if you have been with Investing Education Academy since, like, let's say 2020, when we launched this thing, number one, we've said it's not normal. everything you're going to experience is not normal. However, we also said take advantage of it. Take advantage of it. You know, we bought cars, we bought houses during this time period. We have. We hope some of you all have. But now there are people who are going out and their mortgage is essentially 40% higher than what it would have been just a year and a half ago. A year and a half ago. And let me, why are you all saying this? Because we've had conversations with some people in different markets who've experienced 16% interest rates on mortgages and so forth. So there's still further that these rates will go than where they are right now. So for those of you all who are still thinking, oh, maybe you're new to investing, maybe you're new to buying assets, and you're thinking, okay, I'm used to free money type environment. This is too high for me. I'm going to wait until it comes back down. Personally, I don't think this is coming back down anytime soon. We're not getting back to those free money levels anytime soon. The government has been giving away trillions of dollars. And also for you business owners out there, we've told you, we talked to Joyce Sistrunk, CPA. We talked to attorney Beverly Winstead, the tax attorney. And we have explained, if you're not taking advantage of these programs, what are you doing? I mean, I know personally in money that's been granted to one of my companies, we're talking in excess of like $30,000 that's just given. Like given. That helps. That helps to, continue payroll, to continue investing in the business. Make sure you do the right thing with the money. You track what you did with it. And you talk to your CPA about, submitting the proper paperwork back to the government so they can forgive it. Very important. So just wanted to say it's not the end of the world, but because this report is going to seem horrible. So, yeah, just silver lining.
Yeah. So, and so the programs Brent spoke about, most of those are now gone, right? So if you didn't take advantage, they're gone and they're not coming back anytime soon. And so yeah, as I was saying, so we're now at the point where the Federal Reserve is tightening rates. So first half of the year was terrible, horrible, horrific, worse than 50 years. Main reason for that is the Federal Reserve is raising rates. Rates are going back to what they were, roughly what they were in 2008, 2007, 2008, where they were pre the credit crisis. Back then, they actually lowered rates to where they are now. So the market. So now, okay, that's the bad news, right? 6 months, terrible first 6 months. Now, bit of good news happened last month. So every month now, one of the main things that's moving the market that never did before is the CPI report, the Consumer Price Index report, which is the inflation report. Every month now, everyone's waiting for that to see what happens. It was terrible last month again, but a portion of it was actually better. So there's something called There's something called the headline number inflation. Then there's something called core inflation, which covers food and essentially gasoline for our cars. That went down slightly, right? So the headline number was still big. I think it was like inflation was up like 8.6%. That core number, I don't remember off the top of my head, but that core inflation number of food and fuel was actually down year over year. So that's a crack. We're seeing a slight crack in inflation. Other thing is that if anybody's been paying attention, gas prices are actually starting to come down. Oil, which is the main input in the gas, at the peak was $120. I think today it closed at like $97. So oil has dropped, over $20 over the past week and a half, 2 weeks. So what are called input costs or even commodity costs, they go on everything. Like, you need you need rubber for cars, you need wood for homes, anything, any commodity, corn for food, all the commodities, which are the major inputs in the stuff that we use and eat, those have come down dramatically over the past 2 or 3 weeks. So we're starting to see inflation actually come down. So what the Fed is doing by raising rates, it's working, right? It's slowing the economy. It's slowing buying patterns. The first quarter of last year, the economy actually contracted by a little over 1%. And the classic definition of a recession, and so we talked about this before, are 2 consecutive quarters of negative GDP growth. Last quarter, it was negative like 1.3%. Right now, the Atlanta Federal Reserve is predicting that the second quarter, which we'll get the report on that sometime this month, they're predicting that the GDP for the second quarter this year will have contracted by 2.1%. So that will mean technically that the United States is in a recession. Sounds terrible. That's actually a good thing
Yeah,
because
it really, yeah.
what the Federal Reserve is trying to slow the economy. Because remember, we have all this inflation that's killing all of us because there's so much, all that money that the Fed pumped in the economy the last 2 years. We're spending like drunken sailors, and we're pushing up the prices of everything, on top of supply chain issues, on top of China, on top of COVID. So it's just a perfect storm of too much money chasing too few goods. But what the Fed is doing, commodity prices are down, core inflation is down. We're not out of the woods yet. Like right now, remember the headline number is on inflation was 8.6%, I believe, last quarter. The Federal Reserve wants that headline number to be 2%, 2%. So there's gonna be a lot more raising of rates to slow the economy that much to get us down to 2% inflation. And we talked about this before. Also, another thing they want to stop is what's called wage inflation, because what's happening right now is right now there are 11.4 million open job positions, and there are only about 5.6 million workers. So that means there's about 2 jobs for every 1 person. So that means like if you quit your job, you can go across the street and ask for a higher wage, because if they don't give it to you, you're going to go across the other street, and they're looking for you too. So wage inflation is something that has to stop too, because every time you go out and ask for 30-40% raise because inflation is so high, the company that hires you then has to raise the prices of their goods that we all then buy, which causes inflation. So what the Fed wants is to actually increase unemployment, because let me not
No.
what they want to do is they want to bring down the number of open positions, I should say. If unemployment increased too, they wouldn't exactly be mad, because that would slow the job market. But really what they want to do is they want companies to shrink the number of job openings they have. So we all can't go running across the street at all these different companies and asking for these higher raises. So
they're trying to put a dent in the Great Resignation.
yeah, right. Yeah. So the term Great Resignation, what that means is I think last quarter or last month, over 4 million people quit their jobs. The month prior to that, I think it was 5 million people quit their jobs. So people are quitting their jobs at this unheard of pace, and everybody's like, okay, where are they going? Are they going to get new jobs? Well, some are, but then also if we had this huge worker deficit, not all of them are going back to work. Brent and I spoke about this before. There were 5.4 million new businesses started last year. So a lot of those people that quit last year, early this year, are starting new business. So they've been removed from the pool. Oh, another big one is that a lot of older people that were in the workforce retired because they didn't want to go back in the office because of COVID. So there are a lot of factors that are leading to this worker shortage. But one of the Federal Reserve's main goals is to get down wage inflation. And all that means is that me and you, when we go for a job, we're asking for a 30-40% raise, because we know inflation is so high that we need this money to help buttress the height of inflation. And so, but they do that by reducing all those jobs that are open. And that in turn, there will be a time when the unemployment rate goes up. Right now, it's about 3.6%. They're saying it'll probably get to like 5%, which is still low inflation, but probably get to like 5% before we see like real inflation kind of go away and get back to 2%. So that's kind of the good news, right? The good news is that inflation is starting to slow slightly. We're nowhere near the woods. The Federal Reserve next week we have another rate hike coming. It's probably going to be another 75 basis points, or a 0.75% raise. So again, remember, every time they do this, any variable or floating debt that you have, your rates are slowly creeping up. Credit cards, anything. What else?
Especially the variable rates.
Yeah, that's what. Yeah, anything
if
that's
you
a
have
variable
balloon-
rate. Yeah, any variable rates you have, if you have like ARM on your house, credit cards are definitely going up. Every time they do this, the cost of money is getting more and more expensive. So
And
pay attention
please
to those. Pay attention to the debt you have.
hear what we're saying. This is like, share this with your friends. Hit the share button. Tag somebody in this. Please do not think, oh, I have an arm on my house, I'm just going to wait till next year when rates are back down to like near zero. That's not going to happen. If you know you have an arm, if you know flash that you have an arm on your house, an investment property, anything else, and you're thinking, well, the rates are almost 100% higher than what they were a year and a half ago, I'm going to wait until they go back down. That more than likely is not going to happen. So if you are thinking about it, please go ahead. You have to look at your financial situation. This is not financial advice to any one person. Everybody's situation different. Please consult your tax professional. However, with that being said, I will highly suggest you give strong consideration to just doing the refi now before one day you look up and these interest rates that are 5% are 8, 9, 10%. And you're like, why didn't I do it at 4 or 5? And
yeah, because right now, so mortgage rates have actually come down the last 2 weeks. They peaked at about 6.4%. Right now they're about 5.6, 5.8%. But again, we have a most likely a 75 basis point, 0.75% rate happening next week. August, there's no raise because the Fed doesn't meet. September, we don't know. There could be 50 basis points. It could be 75 basis points. It could be 1%. We don't know. The Fed came out today with their minutes, their meeting notes came out today. And they said, basically, if inflation does not start to come down, they will keep their foot on the gas. They will go and raise another 75 basis point, another 75 basis. Like they're going to just keep raising until they crush inflation. And typically, in the past, when the Fed would raise rates and the market would like go crazy, they would be like, all right, they take the foot off the gas and they either stop raising or they cut rates. That's not happening. The reason they could do that before, there was no inflation, right? They were just trying to normalize policy back then for the sake of normalizing. Now they're raising rates for a specific reason. That's inflation. They cannot take their foot off the gas because they have to stop inflation. So, like Brent said, if you're under the impression that rates are going to be going down anytime soon, that's not happening. There is a theory that if we go into a deep recession, either this year or next year, the Fed would then look to cut rates, a few months after that, if and whenever that happens. But right now, with the unemployment, with the job market being so strong, and consumers having so much money in their bank accounts, the thought of a deep recession isn't really realistic. So yeah, the notion that rates are going back to zero, not happening. Those days are over. Could they be cut in a year or two? Possibly, but not anytime soon. The Fed has said if inflation does not come down, they're going to keep their foot on the accelerator. So debt is going to get much more expensive going forward.
Now, for everybody who's thinking, oh my gosh, this doesn't sound great, it actually will when rates possibly hit like 8% or something like that. So we've seen, you go back to Reaganomics and some of these eras where there was like 16% interest on a home. That hurts. But when people were at 16%, it was just normal.
Mm-hmm.
So just understand where, sometimes people have this thought that I'm just going to wait for it to get back to where it was. This isn't, we don't believe that this is the time for that. Every day you need to take advantage of the situation. If you're in the market, if you're investing in stocks, personally, this is a great time to dollar cost average back into the market if you got out. The reason why I wouldn't just dump a boatload full of money into the market is because I feel like it has further to drop. But at the same time, I don't want to be an idiot and miss these discounts on some of these extremely attractive stocks. So, just understand we're not staying away from the market. We're just making sure we're smart about it. If you're a member,
oh no, good.
No, you got it.
So as you say, on that point Brent said about the market dropping, and I mentioned this I think on the last podcast or 2 podcasts ago. So right now we're in a bear market. And a bear market just means when the stock market is down 20% or more. The S&P 500, which everyone calls the market, was down about a week ago. It was down. It hit like 21%, 20 or 21%. So we're in technically a bear market. We're a little above that now, but we're in a bear market. But typically in bear markets, the market goes down anywhere from 20 to about 30%. So the market priced in a bear market even before we hit the bear market. We were down 20%. The market was down 20%. Sorry, take that back. Recession. During recessions, the market is typically down anywhere from 20 to 30%. We're not in a recession yet, but the market is anticipating recession because the market was down 20% prior to recession. We don't know if we're in one yet. We'll find out that in probably another week or so. So if we are in a recession, the market's done a lot of the work. Could it go down another 10%? Yeah, possibly. I mean, we don't know what it can go down, but we're just giving you stats and just saying typically it goes down 20 to 30% during recessions. We're down 20% ish now. So I've been buying the last 2 weeks slowly, just nibbling, and I've mostly been buying actually ETFs, just because I'm more buying sectors than individual stocks, because right now this market's so crazy. Who knows what any individual stocks is going to do? So I've been buying ETFs, but I have been buying, right? I mean, I know we're down 20%. I've never seen a market down 20% this long. Like I said, the one we had in COVID lasted all of like 2 days and then took back off. So this is just a tremendous buying opportunity. Hurts right now. Totally agree. My account feels it too. But I'm gonna, look back 3 to 5 years and be like, man, I'm glad I bought during that bear market quasi recession in 2021.
Yep. And so for those of you all who are like, what's going on inside IA? Like, what are you all talking about in the platform? Because if you talk about this here, I'm pretty sure the information there is fantastic. It is. And so we are looking at real estate, and we're also looking at our strategy for getting back into cryptocurrency. So I've been buying back into the crypto markets, and I've been out for a while. We won't go into that today because that could take forever. But if you are interested in joining these conversations, we have a cryptocurrency mastermind every first and third Monday of the week. Our IA Portfolio Panthers, well, we meet every first Sunday of the month, and we're talking about investments from international land, domestic land. We are now looking to start to interview or allow people to pitch to us. So if you have a business and you're thinking, I would love to pitch, or if you're a person who wants to invest in startup companies, similar, we're building like a Shark Tank type of ecosystem. And if you want, I would love to be on a panel, or here's these people pitch, you have to become IA Portfolio Panther. If you want to pitch to us, you can go to iaportfoliopanther.com. And actually it's iaportfoliopanthers.com. And just click the button that says pitch to the Panthers, and you can actually pitch your business or business idea. You can apply to pitch your business idea to us, because we're not going to hear everyone. But we're looking to invest a significant amount of capital into startup companies, because we have to diversify our portfolios as well. And when you look at the wealthiest people in the world, they own a lot of pieces of a lot of different things. So we are going to follow that model. And there's a lot of people who think I'm going to keep going to work and save my money in a savings account, and that's going to be enough. It is not, because the United States economy looks like it's in for a rough run for a few years. And so you have to really figure out, like, how are you going to invest? How are you going to grow your money? How are you going to make sure that you retire on the right side of the fence? Because if things get hella expensive, the money that you have, the buying power is being lost every day in a bank. So
yeah, and this just real quick, this downturn we're seeing right now is a perfect example of diversification. Why should you diversify, right? It's like, 99% of what we talk about and what we do in IEA is stocks, right? And that's our bread and butter, that's our first love. But as Brent said, we're looking to diversify into, through IEA and through the Portfolio Panthers. We recently bought beachfront property in beachfront land in Ghana, right? We've done that. We diversified there. We're looking at doing some real estate deals in the U.S.
Yeah. Hold up. Let me do this. We normally wouldn't do this, but I'll do it just because it's live. It's fun.
So I'll just say that diversification. This is the reason why you want to diversify outside even just stocks, because right now we're going through a bear market, right? If you have your money in real estate also, or if you own real estate properties, you're sitting pretty. The real estate market is through the roof. The land that Brent and I bought in Ghana, like 6 months ago.
It was like October of last year.
Yeah, so
about 10 months ago.
Yeah, on that land that we bought, and again, it's beachfront property in Ghana. We're already up 30 to 40% on that land.
45%.
About 45% we have a return on that in about 8 months. So this is a good example of why you want to diversify your investments. Not just have stocks. Stocks is great. That's our number one play. But we've learned through the years that you also want to have real estate, land, even international things. Diversification of different asset classes are as important as diversification of individual stocks.
Yeah, and then you got the bond market, you got life insurance. Mm-hmm. It's some people getting demolished in life insurance right now who are so variable universal life, IULs, they're blowing up right now. Like, the thought was that the market was always go up. And so you bought these types of policies because you thought the market will always go up. And now if you own a variable universal life insurance policy, if you own an index universal life insurance policy, I suggest you call your agent and just ask, is the value what it was when it was quoted to you? I'm not trying to blow up anybody's spot if you're an agent out there, but this is why traditional whole life wins. It's guaranteed. It doesn't matter what the market is doing, and you don't have these highs and lows emotionally and what can possibly destroy your policy in the long run. So I will make a phone call. And again, for those of you all who are thinking, oh, that's just one comment, it's a very important comment because you're going to keep paying your premium thinking everything's the same as it was when I got this proposal sent to me, and it is not. So,
okay. So sorry, you were showing something. You put something on the screen.
It was just a flash. It was for people who pay attention. It was just a flash. If you want to know what it was that we just showed, you have to send me a direct message. It was clickbait. It was
and that was one of the investments we're looking at. So
yes,
that's why.
So I wouldn't even say that, but okay, cool. Leon gave you too much information. But we owe you all 2 stock picks or cryptocurrency. So we will put one of the picks inside of the Facebook group. And if you are not already on our Facebook group, it's pretty easy to get to. The information is at the bottom of the screen. You can go to Facebook and search Investing Education Academy. And more than likely, we will be the first thing to pop up. Also, if you want to get both and see the running list of all the stocks that we picked, you can go to IEAnow.com and become a member of IEA. And if you're already a member, log in, you can see the running list. And this Saturday, Leon and I are back in the hot seat to talk about the investments that we have suggested and if they're still viable. This was actually very telling. When we did this, we thought all of the stocks we picked were going to be crap.
Right.
So we had this talk like somebody on here gave us a comment and said we should go back and look at the stocks that we've picked to see how they're faring in this market. Surprisingly enough, of the stocks that we covered, I think that just sector of stocks, that selection of stocks, overall was up like 33%. And we were shocked. But at the same time, Brent and Leon.
So, right. And we thought they'd be down because everything's down, right? Like everything is down big. But remember those. So what we did, we went back to when we first started in April of 2020. So we covered that first block of stocks first, and over the past two and a half years, they're still up, right? So even though we're down 20% in the market right now, some stocks are down 70, 80%. That batch of stocks was up, I don't know, 20, 30% still. A lot of the stocks are up 20, 30%. So, and again, 2 years to us isn't long term. We say 3 to 5 years or more. But that's just an example that even during a bear market, the market's down 20 to 50%. Because we've been in the market those picks were 2 years old, they're still up. So that's just again, a testament to long-term or longer-term investing.
Yeah, and we covered, I want to say like 12 stocks. Only 2 of them were negative.
Yeah, over the 2.5 years, yeah.
Over the 2.5 years, only 2 of them were negative, and they weren't negative by a lot. One of them got demolished. I'm not gonna lie, but we're doing this because somebody challenged us on one of these lives and said, "Hey, why don't you do this?" Jessica, thank you, Jessica. We listened, and we were scared doing it, but it worked out. So everybody, if you're not on the hot seat Saturday, you can watch the replay. If you already remember, we post the replays for people to go back and dive through it. There is a podcast that we did. I want to say it was sometime in April. I want to go find it. When I find it, I'm gonna post it in the platform. Leon and I did a hot seat where we deconstructed a portfolio of like one of the top investors in the market.
We did. I think we did. We've done Warren Buffett and Carl Icahn.
I think it was the Carl. How you say his last name?
Carl Icahn.
Icahn. He had a stock in there that was paying out a dividend of like 12%. And we were floored. And we went back to check the historical payout of this particular stock. And it's been consistently like 12, 16, 9% for years. So I want to go back and actually check that because I'm curious to see what that stock is doing now in this economy, even though it was only 3 months ago. But I do want to go check it out. And when I find it, I will personally post it inside of the platform so you all can buy that stock because it looked amazing.
If you want, not financial.
Yeah, not financial advice. I want to see some more recent picks. I'm only a year and a half into investing in a brokerage account. Okay, tell you what, we've already committed to looking at some of our older ones, but what we'll do is Leon, if you can remind me, we'll pull 2 stocks from, say, that we picked in January.
Okay.
And see how they're performing. So we just need to remember in the hot seat on Saturday to give ourselves time to go over 2 more stocks.
Okay. And so just real quick, because everything is down, you need a base of comparison, right? So our base of comparison will be either the S&P 500 and or that stock sector. So just so we have something to compare it to. So we're not just saying, oh, it's down 20%. Well, if the sector's down 50%, we're looking pretty good. That sort of thing. So just FYI on that.
Yep. And I'm telling you all, if you're not an IA member, you're going to really be upset later on. Leon's working on a fintech company. That's all I'm going to say. And it's going to help. It's going to help those that aren't familiar with the market in a huge way. So we have meetings with some VCs and some other things coming up, but we're going to be making sure that members inside the IAA get the benefits of the software before the general population. So there are benefits, definitely benefits. Everybody, thank you for being with us. Leon, I probably told too much, but I'm excited about it. Yeah, we will see you all. We will see you all next Wednesday.